It's 6 o'clock in London, it's 1 p.m. in New York, it's 1 a.m. in Hong Kong, 3 a.m. in Sydney, 10 a.m. in San Francisco, and 10:30 at night in Mumbai. It also happens to be 8 p.m. in various parts of Asia as we're speaking at the moment because, unfortunately, due to various constraints, including, well, you might guess it's a bit breezy here, we're going to have a storm at some stage. So we're getting in early with today's show. So I'm sorry that we can't have as much live listener interaction as normal. But greetings, good morning, good afternoon, and good evening, depending on where you are in the world today. My name is Patrick L. Young, the IPO-VID live stream series 11, episode 4. That's episode 64 starts here. Tragically, we've got to start on a sad note once again, ladies and gentlemen. The world of exchanges is a smaller place again this week as we lost one-time junior naval officer and full-time career market maven, a devoted exchange investor reader, Chris Pryor-Williard. Chris was at the forefront of multiple developments, and despite suffering ill health in recent years, he was still, even when he couldn't speak after a stroke, working assiduously to try and prosper and progress the entire parish of exchanges and market structure. Chris will be sorely missed throughout the parish. Our appreciation to Chris can be read on LinkedIn and Medium. Over in Israel, the chairman of TASE has resigned. An interesting letter. Chairman Steinberg seems to be pointing the finger at major shareholders, Shane Finemore and Russell Abood, who through Manikay Partners have been, it seems, refusing to give him any degree of incentivized options-based payment. And as the aircraft take off from behind us at Providenciales International Airport, we can report about CoinFlex. They're launching the first US first exchange. They're going to be offering zero-fee trading and an interesting stablecoin. Quite how zero-fee trading actually works in the incredibly expensive world of crypto, well, it all sounds a bit like if Carlsberg did crypto exchanges, aka it could be too good to be true. Elsewhere, Binance, great news everybody, Binance has a holding company, a location, a physical headquarters location they're going to be announcing in the near future. Or is this another case of Binance flirting with the notion of physical presence with a regulated HQ? They've certainly had a long history in that department. All this and more has already been covered in greater detail in Exchange Invest Daily, the unique newsletter of the Bourse Business. Send us an email or hit me up, Patrick L. Young, on social media, whichever stream you're watching this on, Facebook, LinkedIn, or YouTube. And we can get you signed up for a free trial to understand the business of bourses. Our guest today has colossal experience in the business of bourses, building them, energizing new markets. Thomas McMahon, he's an exchange architect with extensive experience across the gamut of energy as a director of NYMEX and more recently a welter of initiatives from Asia, where he now lives in Singapore. From helping launch WTI to Henry Hub and New York Harbor gasoline, liquid natural gas, LNG, and more, he's recently been moving into the renewables space with Air Carbon Exchange, where he is a co-founder and CEO. Tom maintains a fascinating portfolio of interests in Singapore across exchange-traded derivatives, over-the-counter products, central counterparty clearing, and often involving blockchain technology as part of the mix. Tom, good day to you. So, where in the world are you today? Welcome to the show.
Yeah, thanks very much for having me. Yeah, I'm in Singapore, where it's all summer, all the time. So, and we're just coming off a long holiday weekend, which is quite nice, and things are getting back to normal here.
That's fabulous to hear altogether. Well, Singapore, from Singapore to we're in Providenciales in the Turks and Caicos Islands today, beautiful by nature. Just looking behind us is a view onto one of the many canals in the intricate network of canals across these islands. If you've got any feedback, do please send us some love, ladies and gentlemen. We'd love to have a little bit of a love, like, or any other comments you're welcome to make. So, Tom, tell us, I mean, you've been in the exchange business now for what, 30 years, and you've been centered around the energy business. Seen rather a lot of change during that time.
Oh yeah, no doubt. And actually, it's been a little bit longer than 30 years, but 30 sounds better than 40. So, um, yeah. The world I'm in today is significantly different from the world I entered as a young boy on Wall Street as a write-up clerk and a phone clerk, and the land of paper and pencils that still had erasers, where you could make changes on your trading cards. But yeah, it's quite dramatic, but it's a market that never stops evolving. And I think this year is really significant, obviously coming out of COVID, but we've seen an extreme interest in, where we had sort of these parallel universes for the last few years around digital and crypto living one life and traditional markets architecture living another, and not necessarily thinking ever the twain shall meet. But I think we're seeing a confluence across this year, and especially with some meetings coming up with the CFTC later this month, it's going to be really interesting. So I think great opportunities.
It's fascinating, isn't it? I mean, this whole FTX proposal, obviously you and we bumped into each other most recently in Boca Raton in Florida for the FIA conference just a month or so ago. And certainly it was interesting there, wasn't it, how suddenly we seem to have had an almost crypto domination of the event, or at least a blockchain crypto domination of the event.
Yeah. I mean, I think if probably the acceptance really began, I think, with ICE, when ICE set up BACT, right? And they did it very strategically, set up this isolated entity, called it a warehouse, and interconnected it to the clearing system, but held it fairly at arm's length until they really got some comfort with it. And now, with Gensler allowing for the futurized version of Bitcoin, and now you're seeing an ETF grow on the back of a futurized version of Bitcoin versus a spot version of Bitcoin, and so you're seeing this slow crossover, but at the same time you're seeing a generational shift of investors that are not reticent to be digital first and traditional market second, where up till probably 2 or 3 years ago, really it was completely inverse. It was. So I think that's a significant difference in the year ahead.
Yes, absolutely. I mean, when it comes to energizing new markets, it's very interesting. I don't know. I thought Boca this year felt a little bit like maybe 2000 or 2001, where suddenly all of these technology-based people had taken over, and the old open outcry floors seemed to be suddenly looking like dinosaurs. And then, of course, within 5 years, all those guys had pretty much all disappeared or been embalmed and joined into the whole legacy exchange network. I'm wondering what you thought about whether you think it looked a bit like that this year.
I'm not looking too embalmed, and I'm part of that transition. So thank God. But you're right. It was the first concept of electronification really rose with the NASDAQ market, right? With that whole the 9801, and then it disappeared. But the concept was already there, and the ability to take electronic market data directly from a floor upstairs and trade in parallel with the markets. And obviously, we saw that transition, and it's been other than the LME, it's been completed, right? It's done its entirety. Mm-hmm. But I think it was interesting seeing FTX and Coinbase, and where Coinbase was something radical and out of the box just 24 months ago. It's really sort of mainstream. It was FTX that really pushed the boundaries, and the concept is, I think, really doable. It's actually something I've been personally looking at when I first, going back almost 4 or 5 years ago, I wrote the first ideas around a blockchain-based clearing architecture and disintermediation, and all the buzzwords, but it was really about scale. And FTX, I think, is the first one that really can bring scale, and that's the significant difference. Yeah. So it's a challenger, but a challenger with a logic around it and acceptance. Yep.
Yeah. A challenger with a logic around it. Yes, I like that a great deal, and I think it's true. I mean, what interests me is how we're probably going to see the legacy exchange world working to try and cannibalize what's already come through the system from the new guys. Because certainly we saw that in 2001, 2005. There was this incredible amount of upswing.
Yeah, and I think also the transition now is, if you look at the rise of the electronification of the main exchanges, where NYMEX had its own system called Access, and CME, Globex, but they were proprietary in nature. They're albeit Access is gone and Globex is the dominant one, and then you have ICE and its tech platforms, but they're still silos, right? They're still fairly well controlled, whereas this new world it's doing exactly what it's saying. It doesn't have boundaries. It has rules in theory, and more rules will be imposed on it, but it's really, you don't have that it's not a vertical, it's a lateral, I guess is the better way to put it. So market access, data dissemination, fee structuring, I mean, and it's a honing process. There's no doubt. I mean, there's inefficiencies and efficiencies in both markets, right? And sometimes the inefficiencies are the ones that drive a lot of value, right? I think data clearly is stated that. I mean, the revenue tails on the back of ICE are they're in excess of 50% of their yearly revenue is data driven, right? Where an exchange was about execution previously, it's not. So now you have this new digital market architecture that's breaking that barrier down about data, right? It's proprietary in that it's generating it, but it's interoperability and portability of the data. Again, I'm calling it lateral versus the verticals, and I think that's a significant shift that we're seeing.
Yeah, it's really interesting. I mean, you make the point about the lateral versus vertical, and I see that. It's very clear. And also the data point is well made, because actually going back to one of the very first comments you made, you were first on the floor where you had people writing on trading cards with pencils and erasers. And now we're at the point where everybody has such an order trail and such an auditable order trail that it's quite incredible, because there's so much data held together. So the amount of data just balloons, and the speed of processing is so much faster. Yeah. Very true. Very true.
I think the significant difference too is when I first started looking at blockchain, I didn't look at it from transparency standpoint. I was looking at it fractionalization, the ability to own define beneficial ownership, fractional holdings that you could buy, trade, transfer, and put a commodity into a blockchain. And that was really very simplistic, and then, post that, you've got the pure digital assets that came on the back of that, post Bitcoin and ETH and all the other iterations. The difference is that exchanges, and you took at regulations in the world that I came from, it was anonymous, very anonymous. The whole idea was really to keep the anonymity intact and give as little information as you could to anybody else other than a price or a volume or something like that, and sell that, right? Or utilize it internally. Post, let's go with Enron first, and then Lehman second, and all the iterations, and Refco and Mann and everybody else. The government pushed more and more and more about, give us a data dump every day, and it goes directly to the government, in real time, and blah, blah, blah. But it's still not seen. Whereas from a regulatory standpoint, blockchain, which was being castigated as the most anonymous thing in the world, and lack of audit trail, and all the other iterations of, finger pointing is completely inverse. Yes, it's anonymous, but it doesn't have to be anonymous. I mean, there's so many more choices in real time in terms of how you can look at a transaction, like an Etherscan, right? You can see every ETH trade fundamentally in real time on mainnet if you want to do the work, right? As opposed to an exchange holding its data every day and sending it directly to a regulatory body by mandate, and it's good, but it's a very different metric, I see. So I think people are finally getting over that concept of, blockchain is for money launderers. It's so the other way. It's so 180 degrees. That's the last thing that somebody's going to use, right? Is my point. So. And once you get past that, and I think people have gotten past that, they're beginning to realize, oh, this actually works. It's got a tremendous amount of functionality around markets architecture and a lot of the things that we need going forward in a new markets architecture. And it is definitely disruptive. There's no doubt. But I think the acceptance is significantly different. So literally the 24 months, 36 months we've been through COVID and everything else, and coming out the other end of it. And I think that story is gone. And now it's into how do we marry the two in a logic that everybody's comfortable with? Clearly, from a regulatory standpoint, but also traditional markets adoption. Now you're seeing more and more of, you're seeing the BlackRocks of the world. Not, you don't hear Jamie Dimon going, oh, Bitcoin's a bad thing. Now it's like, they're embedded in looking at use cases around it and adding it to asset classes and portfolios, and so collateral management and trade finance. So that's the transition we want to be in. So yeah.
Well, it's the ability to capture data, to store data, and to hold it at a point where it's actually essentially audited itself on the way through. It's just absolutely phenomenally powerful. And as you say, it was so funny watching people in the early stages of Bitcoin think it was an easy thing because they just got this stuff sent to their address and then they were free and easy with their crime. But it's essentially the same thing as having the ultimate baddie's lair, isn't it? I mean, you could be up the side of a mountain somewhere in, I don't know, Vietnam, but at the end of the day, the police can still surround you and you've got to come out sooner or later. So it's very easy to stop you. And that's the sort of stuff that people just didn't think through. I mean, good old-fashioned cash notes actually, that reason why they always wanted in the movies the idea of unnumbered or numbered unused notes, because if you had the unused ones, you would track down. And I mean, Bitcoin did that in steroids. So look, I mean, it's really interesting because you obviously have colossal experience in architecting exchanges. And you started with NYMEX. You worked with NYMEX while it was developing itself, redeveloping, I mean, really from a quite fundamental era. Yeah. What was it like when you first got to NYMEX and you started undertaking the stuff there, which was really the energy futures revolution?
Yeah, and actually it began. I actually began in the ags industry. I mean, we were all on the same trading floor from 77 onwards, the Commodity Exchange Center, and I began actually trading cotton and juice, and then. And the firms that I was with, I think Cargill was one of them. We were on the physical side of the market, and it always had an energy tail. And the energy tail in the ags markets is LPG, liquefied propane gas, which was a hedgeable instrument. And that actually was traded on the New York Cotton Exchange. The first energy contract in New York was actually on what ultimately became NYBOT and pre-ICE acquisition. That's where I learned the energy business. And then those markets all got very quiet in 81, 82. And it was the early days of the refined market on NYMEX. And it wasn't even called NYMEX at the time. It was called the New York Merc. It had a long name. The acronym came later. And I had basically my ags customer said, hey, can you go over? We need to hedge energy. And that's what got me over to the Merc on the first part. And because I'd worked on committees in the cotton markets and juice, they said, hey, you want to get on the committees at NYMEX? And I said, yeah, I can do that. And it was really very organic. And that's what the members did in those days, right? It was, you remember, you traded, you supported new contracts, and you were on the committees, and you put your hand up and you volunteered your time. So I got on to basically new products committees. And I was early in TI and was there the first day we traded in March of 83. And gasoline and fuel oil had predated that in 78 and 81. And then I got onto the board, and I was the chair of the Nat Gas Committee, which ultimately became the Henry Hub gas contract. But that was on the back of California deregulation, Clean Air Act, ICC deregs on transportation around gas and power lines. So all of that was all really happening in the 80s very rapidly. And NYMEX had positioned itself well, but it was a legacy agro market. It was a potato market that had really fallen on hard times. And it had a chairman, Michael Marks, who really had a vision. And he came out of the food industry, his family, Paris Foods. But he knew he had to do something literally to save the exchange. And so the first crude contract it was launched in 75 on cotton, and it was a Rotterdam contract, but it was too big. It was commercially, it was a 100,000 barrel contract, and it never really could get any stickiness. But the idea, post the second oil embargo in 75, to have a crude contract was there. And he saw an opportunity to adjust it and adopt it and adapt it to NYMEX. And really, it was T. Boone Pickens who actually was the real supporter of that in New York. He was always a bit of I wouldn't call him a wildcatter, but he definitely he wasn't an insider in the energy markets in Texas at that time. He always thought differently. And he said, yeah, I'll support a futures contract in crude. And he did. He put the first order in 1,200 lot ticket on that first day. Wow. It took, I think, 2 weeks to fill the order. The volumes were so low, but it was really the beginnings. And what really made it succeed was actually in '86, when the Saudis, the netback deals collapsed the global oil market, right? You paid for your crude after you sold your products was basically what it was. And they were all violating their quotas, and the market collapsed from $34 to $9 in 2 days. And there were no buyers except on NYMEX. And that really, it's a classic what an exchange is supposed to do. It's supposed to be the buyer or seller of last resort. And that's really what makes it break an exchange. In that case, it was the buyer of last resort, and it put a price floor in at $9, not the price the world wanted, but it stopped it from going to zero. And it recovered, right? And there had been a lot of naysayers going, I don't really want to trade futures in oil. I like the way it is, right? It was a big OTC market in the Seven Sisters.
Yeah.
But suddenly it was like we needed risk mitigation, we needed counterparties, we needed liquidity. And after '86, that was really the beginning of the rise of NYMEX and its credibility on in through the '90s, and then the launch of the nat gas market in '90 and the power markets in '93, and then on into the early 2000s. Enron was another great case, right? The alternative universe was ICE and Enron and NYMEX, and they were all antis to each other. But when Enron evaporated in December of '01, ICE was standing there going, why do I exist? And the OTC world were looking at each other. Literally, the banks were looking at each other. Go, I can't trade with you, because they weren't in a love fest with NYMEX still. But it really became the concept of clearing. OTC clearing finally got sticky, and that was the rise of Clearport and ICE Clear as we know it today. It was that the exchange would take on block trading facilities or take swaps into a market and give you counterparty risk mitigation. And the industry finally said, wow, that's a great idea. And again, so another scaling up of the market. And again, it was exchanges periodically have really great solutions. It's really just about the market waking up to them, and it usually comes in crisis. It's build it, have it ready, and when the market gets unstable, even if it's a blow off to the top or a crash to the bottom, the market is there to step in. It's doing its job of what it's supposed to do. Reality is it's a price model and an insurance model against counterparty and risk mitigation. So not sexy on paper, but in reality, it does work. So, and I think that's what we're in this new digital market architecture evolution. Yeah. So,
well, it's interesting because, as you say, it's a price market, a mitigation market, it's a risk transfer tool, it's something that's there as a last resort. I think the other thing that's very interesting over the period that you describe is obviously when the first crude contracts really stuck in the energy market, everybody was pretty happy to have, a benchmark that was kind of, you could waver on. And therefore, we ended up with West Texas Intermediate, we ended up with Brent crude, which were perfect in their own markets because they exactly replicated Brent, but they actually weren't anything like the crude oil that all the people who had loads of oil had, like the Middle East, like Russia, like all these things. And isn't it fascinating how electronic trading allowed us to go from this concept of essentially one benchmark, because we had light sweet crude benchmark that's almost identical, and now we've got, goodness gracious, we've got half a dozen crude oil benchmarks, plus a load of LNG, plus all sorts of other things trading with incredible liquidity before you even get to the OTC cleared stuff.
Yeah, it's true. And well, if you step through it, if you look at, the rise of TI, TI, the logic about being in Cushing, Oklahoma was almost by accident. It was like we had a contract looking for a home with enough tank storage to take on capacity for what we predicted as a deliverable, right, in tank. And Cushing had spare capacity. Exxon at that time had unused tanks, and it was sort of like, and it had a pipeline interconnect, and there was a logic to it. Okay, we'll use Cushing, Oklahoma. But it's a basket. Yeah, it's got specifications around, right? It's multiple crudes, but if you sit within this band of light sweet, you fit the deliverable. Brent is a region, right? It's a huge region. And so the concept of allowing for baskets actually to aggregate it in and around a single price. It's a price averaging model, but again, it was early enough and people said, but it was the financialization of the underlying, right? And it allowed for the evolution of the basis market. So that basis took a while to develop. I mean, it was single point pricing, and then the evolution of basis pricing, and then the sophistication of the exchanges and the electronic architecture it allowed for the market makers to say, and yeah, I'll do Brent plus minus, right? I'll do TI, X, and Canada, it's got a huge, deep discount to TI, right? The sands, blah blah blah. That was a market evolution over 2 decades, and I think the next layer you've seen is once the floors were gone away and it is all electronified. You're right. We always had these subgrades or variants, right? But they were always managed upstairs, right? They sat on the books of the big Wall Street refiners, if you want to call them that. And they were actually pushed out of the business. You realize post-Lehman, they were told, close those shops up. You can't do that anymore. So it sort of drifted away from the markets, and now it's come back with actually named contracts. So you've got the Houston contracts, and you've got these subsets, and now you've got Merbon, on the Abu Dhabi contract, where Merbon's always been there, but Merbon was always priced against something else. It was never given its own price, and now it can. So, and I think that's it's well deserving, because the scale of it, the production numbers. One that I always thought that should have really had its own price is the Siberian crudes, right? That come out.
Mm-hmm. Yes.
I mean, their daily production numbers are well in excess of some of the sub crews that have prices, but it didn't, because all different reasons, it never got its own price. It was always a basis, right? So, and now it's got less of a chance of getting its own price today, but
yes, I think so. It is currently, but nothing to do with the market. No, never say never, and it's nothing to do with the market structure. I mean, I think you look at the emergence of things like JKM and things like that in the LNG market. It's quite incredible, because as you say, they all started being priced as a basis, and then somebody suddenly realized, whoa, hold on, actually, if I take my Venn diagrams and put them all together, there's actually a cluster of people who would just trade JKM in their own right. And then that fueled the next thing.
Well, it's interesting that whole Platts model in Asia really has been opportunistic on the basis of Platts, and it's really, and I'm not going to say it's a failure, but it's really been a lack of the Asian markets to have really adopt robust commodity trading markets architecture. They if you go back historically, some of the greatest commodity exchanges historically were in Asia, and they basically fundamentally disappeared from the post-colonial period, post-World War II into the 60s and 70s. The exchanges were systematically shut down, mostly by governments, right, who wanted to either get more control of their natural assets. Some of them were natural resources, so they closed up the exchanges. Or they really made a decision that it was easier to trade equities than it was to trade commodities. And some of them were very clear on that. They said it's very easy to trade leveraged paper than it is to actually deliver physical commodities. And they switched hats, right? They focused on national flag flying securities exchanges. Hong Kong is a perfect example. Hong Kong was a center of cotton trading for 100 years, and gold. And after 87, it said, no, we're going to do equities. And they combined them and basically shrunk the size of the futures and grew the equities market. So the rest is history. Japan similarly, and Singapore as well. NYMEX in the 80s into the early 90s was actually the second largest energy trading exchange in the world. And they made a clear decision to shift their focuses to the equities markets and create SGX. So it allowed for Platts to really to exist. You had to price energy and broader commodities in Asia. So the news agencies were given the opportunity to do that, and Platts really succeeded in that, right? And the banks needed to have a price. So it's very been embedded intrinsically. So JKM was almost, for the most part, guaranteed to succeed.
Yes, it's very, very interesting. That's a great point you make. And I had not thought about that before, which is the way that indeed, in some ways, post-imperial, post-World War II, the concentration on financialization, equity products, moving away from raw commodities, in some ways because I think also there was a certain belief that commodities were a bad thing in some ways to be trading with. It was the finished product that was more important. So your Toyota becomes a lot more important than the components that go into it. And certainly it's fascinating. I mean, you think about everybody in the world who's trading today, somewhere along the line, they're going to see a candlestick chart, and nobody would think about the fact that was actually what a rice merchant was
That's
using
right.
that to analyze rice futures prices almost 300 years ago. It's fascinating. So, okay, so you talked about robust architecture there, Tom, and obviously you're a man who's been energizing commodities markets worldwide for quite some time. Now, you talk about Asia having somewhat lagged behind, and here you are talking to us from Singapore while subsequently architecting markets. How did you get there?
It was really, I started traveling to Asia in the mid 90s, and we always had clients in New York from Asia, predominantly from Japan and Korea, that had traded in the commodities market. So they would always visit, but there was really no representation in Asia. So I had an opportunity to move to Japan at the end of 2001, early 2002, and I was a trailing spouse, so my wife had the job, and I took my trading over. So I decided to trade the overnight book, basically the New York book in Japan, and it was kind of fun the first couple of years. And then I actually got a call one day from New York in 03. It was actually September of 03, and guys in New York, the board said, "Hey, you want to go to Singapore?" And I had not been there yet. And they said, "We've been asked to come down and do a presentation to the PM's office and to SGX and MAS on bringing energy trading back to Singapore, right? Basically bring NYMEX to Singapore is what it was." And that was just after SARS. So I came to Singapore on that first trip, and it was a ghost town. It was literally 2 weeks after they'd reopened, and very similar to us coming out of COVID like now, but even more extreme. And the meetings and conversations went on for a year about cooperatively working with SGX. And actually, at that time, floors were still very active, and they wanted to recreate an energy trading floor in Singapore. But a year on, by the end of 04, even SGX had made a decision to get out of the floor trading business. So they decided they were shutting down their floors in 05. They said, "Listen, thanks, no thanks. We're going to go our own way and build our own electronic markets. So you're happy to do what you want to do." And at that point, the NYMEX board said, "Hey, let's open an office in Asia and really professionalize it." So I opened an office in Tokyo and opened one in Singapore. And I went back and forth for the next 3.5 years, scaling up what's now larger CME group here in Singapore. So I started that office with 3 people. So I think it's 170 today. And we adopted, actually, we worked with Platts because there was no exchange model out here. So we took Clearport, the OTC clearing, which had just been introduced in the US post Enron. And we took 3 Platts prices in fuel oil and bunker and naphtha and created products for trade in Singapore, all electronically. And and the business has scaled since then. And then I went through the IPO in 06 with NYMEX, and then the CME acquisition. And then I left, and I decided I didn't. It was time to move on. There's already been a healthy competition between New York and Chicago, and that was Chicago guys who had everybody in control. And I said, I think there's more opportunities, and it was good for me. So I've been able to go on and do a number of other exchange builds in time in Hong Kong, and then one in Shanghai, working with Charles Lee at the Hong Kong Exchange, and then 9, 10, 11, and what's now ICE Singapore. Worked with it, brought that through licensing, and then ICE acquired it in 13. And in 13 was when I started to focus on blockchain. And the first platform was on gold, and doing fractional ownership, beneficial holdings within vaults, the ability to buy, sell, acquire, transfer, and spend in a single platform. And we used gold as a standard to do it. And that was with a group out of Canada, a gentleman named Roy Sabag and Josh Crum. And it was, as you say, the rest is history. And it was really, now I really focused on, I realized that digital markets architecture, smart contracts, DLT, distributed ledgers, the blockchains, and asset-backed tokenization really was I felt was a great representation for commodities, that it could be applied. And then started to look at it even into the equities and bonds markets. It could be an applicable transactional, but even at custody and collateral levels also. So that really has been my focus since.
It's really fascinating. I mean, you built through various exchanges in multiple different jurisdictions. That intrigues me. is there one particular lesson or series of lessons that come from building several exchanges over time?
Yeah, you hope the next one you get it right. So it's like, and I'm being mean. No, the reality is you learn something new every day. I mean, and again, I came out of really traditional markets architecture, and I will tell you this, you and I sitting there in Boca and just after that FTX presentation had closed, not all systems are definitely not perfect. And in the markets architecture, that really the markets are still, even though they're electronic, it's 130, 140 years old. I mean, the clearinghouses that ICE acquired over the last 2 decades, they were built over 100 years ago. Nothing has changed. The idea of the clearing member in the FCM, it's almost identical to what it was in the 20th and 19th century. And now I'm not being a smartass. It's just, it works. If it works, if it ain't broke, don't fix it. But we all talk about risk and reporting and all of the efficiencies, but really settlements, right? T3, big deal to get to T2, to get to T1, but we've got real-time banking now, right? You've got firms like Stripe that can go, on-ramp, off-ramps for digital markets payments, representation of digital dollars. There's no reason why we shouldn't even be T1 today. It should be T, right? We have all the capabilities and logic to do it, but the traditional markets architecture isn't there to support it, right? I have bank windows here. My US dollar bank window closes at 4 p.m. in Singapore. And if I miss that, oops, I'm no longer T. I'm now T1, maybe T2 if I float over a weekend, that kind of thing. So those are, I think, some baseline things that can change and will change in time. But for me, it was really just an opportunity to improve. And one particular thing, especially being on the commodities, is really the delivery warehouse, whether it's a silo or a tank or a vault, or a digital custodian representing an electronic warehouse receipt. They were never really embedded in the exchanges. They're always just loosely associated with the exchanges. And I felt that I never agreed with that. I understood the logic around it, right? Independent warehouse structures and such and operators. But I always felt, especially as we got to electronification and the idea of that you could have a unified system where you had a collateral and a custody and a warehouse-like architecture directly linked to the exchange. And without having conflict in it, but the ability that the exchange could operate it seamlessly, right? And keep it connected at all times in real time. And that's objectively, I always wanted to get to that. I tried to do it with some other physical commodities, even at vault levels around gold. And Singapore, we've been able to do that pretty well. But the nature of an issued voluntary carbon credit was such that it was digital in its purity, and it had always been digital from the time it was first created 2 decades ago. So the nature of it really allowed to have the logic around creating custody and trust architectures, interoperability, smart contract representations of all the metadata, the idea of tying it directly to an exchange in real time. And that's the beauty of the blockchain, the ability to have continuous, we can look every 5 seconds back and forth across the platform and have everything synced in real time against every piece of inventory deposited, against every price, client, account. I could never, you can't do that at the traditional exchanges. As much as they'd like to say here that you can, no, it sits behind layers. Back office processes are disconnected. Yes, there are APIs, and yes, they do talk to each other, but it's not in real time. And I think that's really where the markets have got to progress to.
Yeah, yes, certainly. I mean, you look at clearing architecture, which until recently was like a submarine with essentially a series of periscope that went up at sort of 8 o'clock in the morning, and then about 9:30 after the banking went through, and then they sort of shut down again, and then they put the periscope back up about 11:30, and they'd sort of go, yeah, it looks okay out there, and then if they put it back up again after lunchtime, then and all hell had broken loose. Suddenly it was like, whoa, quick, get a margin call out there, and it's so interesting because when you look at the science of margin calls, and I'm not deprecating the CCP business, neither are you, but you look at how progress has been made. The old days was just like, ping them all for another X $1,000s per contract. That should calm them all down a bit. And it kind of did. But on the other hand, it obviously has all sorts of imperfections in terms of it's a big bludgeoned effect in order to manage to go forward. Whereas, as you say, in real time to be able to see things developing it is an opportunity if there's transparency that you can actually understand, and you can understand who has got things collateralized against something that's in a vault or a warehouse or wherever.
And one of the things, I mean, again, I was a floor trader, right? And we all, you're in this business long enough, everybody goes through the boom bust cycle, right? And it's like you always hope you leave on the boom, as opposed to the bust. But you're riding that wave of margin calls. Everybody did it, right? And some days were out of your control. I mean, in the case of like Gulf War starting and all that kind of stuff, right? But as the market calms down, things get compressed, the risk flattens out, and you pay across as necessary. But the interesting thing is about forcing defaults. I mean, I guess that's one of the big things. That's the concept of what FTX is introducing is that they've got on exchange real-time liquidation, right? Real-time alert systems, and the potential that if you don't post new collateral or currency, we're going to wind you down in this very orderly process. And when you talk to the traditional guys, like going, whoa, what if the guy doesn't want to get liquidated? Well, okay. What if you can't get in touch with the guy that you want to liquidate? What do you do then as an FCM, right? That's, I said, let's flip the question around. Those scenarios exist today, and they always have. So, yeah, somebody being proactive, but that system has been tested. Binance and these guys, and BitMEX and BitREX, and all these guys have tested that system over the last few years. Whether people agree with it or not, the reality is it's been tested. And for the most part, in that retail space.
There were, yes, exactly. And I think there were two strands to, the infamous FTX presentation at Boca Raton behind closed doors to the board of the FIA, because the first part was kind of, we're not really sure that we need brokers anymore and we can just go out to the outside world. Well, actually, we've been talking about this for 25 years or more. I'm not trying to deprecate brokers. The truth is, if you want to be an intermediary, you've got to demonstrate your value to the world. And if FTX or BitMEX or whoever think that they found a model that doesn't need the perceived value add, then that's one thing. And that was actually quite funny, because I think a lot of the brokers were trying to sound like, as you would say in English, disgusted or shocked of Tunbridge Wells, the sort of the Southern English commuter tongue. They were all shocked that anyone could think about this like Captain Renault in Casablanca. But that seems quite logical. Now, the bit that concerns me, and we're not going to solve it today, but the bit that concerns me is when you've got all retail, that's one thing. Because all retail are between 1 and 10 contracts or whatever. When suddenly you introduce one of those, I don't know, Mr. Copperfingers, or one of those many mythical huge position takers of commodity markets, that's where we don't yet have the data to say that this system will necessarily work very successfully.
Yeah, so I had this conversation the last couple of weeks and post Boca with some of the FCMs, and they're like terrified that the world is going away. And I said, why? I said, you really think about it, and this again, transition away from the floors, right? You had clearing members, you had the clearing members upstairs that cleared the flooring guys, right? The guys on the floor, meaning locals and stuff. Okay, and then the way somebody got to a market was somebody allowed you access right into the floors, right? You called your broker or you sent a message, whatever. But you had this pipe and this funneling effect. And then as we transit into all electronification, the key was like the HFTs or whatever, or high net worths. Everybody gave them direct market access, right? So you had this oblique connection to a clearing member, but the clearing member, other than with my client, and I'm going to get some payments out of him for facilitating, he really had no control over him other than he's my client, right? And I've got he's risk on me, but the reality is he goes directly to the market, right? The DMA. Well, I think you've already mitigated the use of the broker in that scenario, right? Because he wasn't the funneling point anymore. well, theoretically with the front end, and you could tune him in on as a risk, and he's a $5 million trader today. Oh, he's only $2.5 million tomorrow, and you banned him. Well, those controls can all still be there. We've got them built into air carbon. That's
right.
That's standard as far as I'm concerned. One of the things, the concern was really the rise of the capital, right? Meaning the lending facilities on the back of the big broker dealers and the FCMs. I mean, a lot of their revenue, because in a low interest rate environment, really a lot of their money is not made on transactions. It's made on lending, right? It's on those margin top ups, or it's on that leverage, right? And so I think the question is, how does that still stay intact with this new business model, right? Where everybody has direct market access and there are no brokers, right? And I think there's a lot of solutions around it. People just have to back off and realize that there's always going to still be a demand for lending, right? Yeah, the problem is it's called DeFi. Somebody already figured it out. It's like the old adage, right? Closing the barn door, after the horses have run. The digital space already figured out how to buy and lend and collect interest on their own collateral assets without somebody else having to figure it out. So, and again, that's a bit of the Wild West, but I think all of this is going to come into line in time. You're going to have the traditional markets architecture adopting. You're going to have the FTX Extreme adapting, and it's going to be a middle ground of really best execution, I think, right? There's going to be lending and borrowing facilities. There's going to be margin facilities and everything, but it's going to be a lot more in real time than it is today. And risk awareness is going to be much greater than I believe it is today, right? So.
Well, and I think, if you look at risk awareness throughout history, it's been explosive how much. If you were to take our, 1987 selves sitting on floors in different parts of the world and think about, we probably thought we were the coolest guys on the planet and knew loads of things. We wouldn't even have recognized 10 years later's floor trader when they were sitting with a tablet computer under their arm that they were using. As they were described in those days, medical tablets, in fact, to do all of their options calculations and so on. And the progress has been incredible. I think the other point I would make, I agree with you totally about the FCM thing. What's incredible to me was, we go to Boca Raton, which is the Futures Industry Association, the Futures Commission Merchants, the Brokers Association. They're actually looking remarkably prosperous, and I applaud them because their commissions have come down 98% over the course of the time that I've been in this industry, which is less than you. Their total business model has turned on its head. They've gone fully electronic from having previously been all about the telephone and shouting at each other. And now they're sitting going, well, this disintermediation thing's going to kill us. And it's like, well, I don't think so, because if you can still offer some form of, as long as you justify why you're in the middle of that transaction, then you've got some justification of why you're going to go forward. But it's a fascinating issue altogether. Looking at the exchange architecture business, obviously we had a great conversation, and actually if you're watching this, flick back through our archives. We interviewed Bill Pazos, who's the other major co-founder of the Air Carbon Exchange, just a few weeks ago with Steve Zwick, and we actually walked through the whole business of the Air Carbon Exchange and its carbon trading. So that's why I'm deliberately not asking Tom these questions today, but you can check that out. It's a great interview. It's live on all of our, it's archived in all of our streams from the live stream there. But you look at the arc of your career, Tom, quite fascinating. You started in agriculture. You then realized that, agriculture was so heavily dependent upon energy. And I love the point about propane. Actually, I'd forgotten about that, because I think it's fair to say pretty much all the first contracts in every area of the futures business ultimately failed. The first stock index was the value line. I can always remember that. If you look at the early attempts, we had mortgage bonds before we had treasury bonds, etc. And I'd not thought about propane gas. Actually, it's really interesting. You started in that. You got into energy. You've now gone through a multiplicity of other commodity, stock, and related venues. And currently, you've built very successfully Air Carbon, which is, as you say, a totally different thing, a born digital, genuinely a vapor trail of a commodity. It's fascinating how this market has expanded in ways that we just wouldn't have dreamt of even 25, 30 years ago.
Yeah, I think probably the most interesting thing about carbon is, and for me, it's a bit of an end state. It ultimately is embedded in everything we do, literally everything. These computers that we're talking on have a carbon footprint that's got to be mitigated in time. So as a commodity, it is going to act like a commodity. The concept of generating a carbon credit, right, is really like mining, right? And what are you mining? You mine trees, right, or carbon removals, or carbon capture, or technology that's going to be so far out of the universe in the next 30 years that maybe we haven't even thought of what it is yet, right? How we're going to pull carbon directly out of the atmosphere, right? Or we're just saving nature in that case today. But you're incubating products similar to how you incubate or grow commodities, right? And carbon really, I'm representing it it's a digital asset by nature, but it's a representation of a real thing. And if whether it's a peatland restoration project in Sumatra, right, or a methane gas capture project on the back of West Texas, right, in the Permian Basin, it drives an economic event all the way down to the bottom. Whether it's an indigenous village, right, that used to be into slash and burn technology and lumbering, or you've got a sophisticated energy industry that's now got excess well capacity, and they've got methane leaks, and they've got to do the right thing and capture it, right, or reutilize it. There's so many different iterations of it, but the underpinning is that it's 1 ton of CO2. So it's going to be, the price effect is no different than the price effect we have today with what we take for granted in terms of oil. And when oil came into our lives 40 years ago, right, the embedded price of energy is a foregone conclusion. We don't even think of it today, but we get up every day and everybody goes, "Oh, what's the price of oil today?" Alongside of the price of gold and my equities, right? What's the S&P doing, right? If you're in America, what's the DAX doing? If you're in Germany, or Nifty in India, right, or Nikkei in Japan, carbon is going to be that same thing. So that's the really interesting part of this. So it's it's significant, and it's early in its significance.
And it's a very interesting thing you mentioned, actually, because you're right. Carbon is embedded in everything we do. But at the same time, it's going to be fascinating to see, will we ever see someone's carbon price appearing on the news bulletin? Because that's actually what you just gave us, was you gave us the news bulletin. If you're in India, they'll tell you the Nifty did this, and then they'll probably tell you the NASDAQ or the Dow Jones did that. And if you're in London, they'll tell you the FTSE did this, and then they'll say the Dow Jones or the NASDAQ did that. And they'll maybe tell you what went on in Tokyo with the Nikkei Dow or something like that, and gold, etc. And now they're telling us what the price of Bitcoin is most days, despite the fact that Bitcoin isn't actually owned by that many people, but it's very actively traded. Fascinating, because we're all effectively carbon traders in the same way that we're all energy traders, because we all use it.
And it's really about awareness and willingness, right, to finally put that price, right, whether it's through a carbon tax or a voluntary market or an allowance market and such. But the price is going to be a price of carbon that's going to be with us for the rest of our lives, right, at every commodity level, every transportation level, and the building industry and all that kind of thing. So it's a willingness, it's a policy change, no doubt. But your point, will we see a price of carbon? Now, and there's a great debate about that. Will ever be a single price for carbon? I do not believe there will be. I believe there'll be multiple prices for carbon. The same way there's no unified price for oil in the world. We have multiple prices for oil, but it's still oil. It's the same BTU, right? And they're in barrels or liters. There's a ton of CO2, but I think you'll see different prices, and simply because the nature of whether it's a carbon removal or a carbon sequestration product, or a reforestation versus a mangrove replanting, blue carbon, right, versus methane gas capture, and so they do all represent the same thing, right? It's the removal, mitigation, or sequestration of a ton of carbon, but it'll be done in different manners, so it'll have a different price. So I think that'll be.
Namaste. I'm in total agreement. There's not going to be a single carbon price. I totally see you. It's just going to be like energy across the world. So quickly, before we finish the show, I want to ask you that big high-level question. Where do you think the revolution goes next?
Wow. Yeah. The life of it's generational, I think. I think we're to me, I think we're seeing, we hear these conversations around the concept of digital money, right? You know, the rhetoric around, you
Yes.
know, that it's already done. And it's done at generational. I think if you talk to anybody below the age of 30, it's like, yeah, and they've actually probably never, yeah. So I mean, I think the argument, it's obviously it's a mature conversation. It can't be just be done rebelliously, but I think the adoption of the what we are calling the digital revolution is already done. And I think if you look at like a country like Indonesia, where more than 50% of the population is below the age of 30, 295 million people, it's so embedded and it's so natural in their day to day. And it's still an emerging nation. It's still got very rural areas, but they're all interconnected digitally, right? So electronic payments is a foregone conclusion. So I think really that is, I think, probably the most significant thing. So that argument of, the CBDC, right? You know, the whole concept of a central bank digital currency and everything. We electronified money, a decade ago, right? We electronified stocks. We dematerialized them 2 decades ago. Right? No one questions that. So that's really where I think it's just really, it's market adoption at a generational level. Yeah.
Fabulous. Absolutely fabulous altogether. The digital generation, I think we both belong to what I would call the bold generation, born analog, but we're living digitally. I hear you in what you're saying about the under 30s. They're already in a world of digital money. We're going to be discussing more about exchange data with Jonathan Block, disrupting exchange data internationally. That's going to be our next show coming up, ladies and gentlemen, on the 17th of May. Usual time, 7 p.m. CET or 1 p.m. Eastern, 6 p.m. London. Today, we've had this absolutely sensational discussion with Tom McMahon. It's all been about energizing markets and the architecture therein. Carbon is embedded in our very epicenter of our daily lives, but I would say something else is embedded therein as well. And I hope you've gained the bug from another market maven, Tom McMahon, talking us today about building exchanges, and that is exchanges are at the epicenter of what we do because they're the best proven model for facilitating trade, whether it's propane gas, whether it's corn, whether it's anything you care to mention, insert it here and fractionalize it, or indeed it happens to be the wonderful world of carbon with Air Carbon Exchange. That's our show for today. Thank you very much, Tom, for being our guest. My name is Patrick L. Young. The debate continues daily in Exchange Invest. Thanks for watching.